Financial Sustainability Committee for Bloomfield Township quarterly meeting here at Bloomfield Township Hall. Let's begin with the Pledge of Allegiance. I pledge allegiance
to the flag
of the United States of America and to the republic for which it stands, one nation,
under God,
indivisible, liberty and justice for all. Thank you. I note the attendance. We are down two board members today, Trustee Neil Barnett and Chair David Petoskey. At this point, I'll open the floor for public comment. If there's anybody here who would like to address the board, you have 3 minutes. Seeing none, close the public comment and move on. Next item on the agenda is to approve the minutes of the January 24th, 2024 Joint Board of Trustees Financial Sustainability Committee and Retired Employees Healthcare Benefits Trust Meeting. The minutes were in the packet. Are there any questions or comments? If none, I'd ask for a motion to approve. Moved by David Olson.
Second.
Second by Rena Emmons. All those in favor say aye.
Aye.
All opposed? That passes unanimously. Okay, we'll move on to our quarterly portfolio review. I'm just going to give a quick update on the operating reserves, and then we'll move on to the pension plan. And my papers out here. Okay. Sorry. Moved on. Okay. So our operating funds ended the quarter at $94.2 million, which is up $22 million for the quarter. The bulk of that is related to the tax collections that we did through February 14th, actually through February 29th. Through February 29th, we collected taxes, and so we are sitting in those funds, and they're diversified. We keep $2 million in our checking account. We had about $16 million in our money market funds, $5 million in a bank of a certificate of deposit, $25 million in our bond portfolio, and $45.5 million in our local government investment pool that we use, which was MI Class. And as I noted at the board meeting, by moving that money to MI Class, which was about 30 basis points higher than the JP Morgan money market fund, we made over $30,000 in additional interest just in that first quarter. So that was a good move. But that is our operating funds. Are there any questions on that? Okay, let's move on to our pension plan and review the portfolio. We have Brian Green here from Mariner.
Awesome, thank you. So I'll go right into the bound book. You'll immediately notice the change in color scheme and the change in branding. So that all occurred April 2nd. I will tell you, it's been, people have asked how the transition has gone, and I said, it makes you feel better. The only cause for consternation has been my password has to be 12 characters, changed every 60 days with like 2 special characters, uppercase, lowercase. So I've had to shift from child-oriented passwords, like birth of your kids, which I just realized now I have to go change every one of my passwords because the internet's listening, but to like phrases. So that's been the only source of any heartburn over the past of the last month. Markets have been kind. So if you take, for example, in the book, right on page 1, you look at the first quarter, equity markets in positive territory across the board. I would say the big surprise was that fixed income markets were actually in negative territory. Despite a complete lack of any change from a Fed policy standpoint, the 10-year Treasury, for example, in the first quarter went from 3.8% up to 4.2%, and here in April and May, it went up north of 4.7%. So we've seen a pretty significant swing in long-term interest rates higher, with the market, interestingly enough, ahead of the Fed yesterday saying not only no action, but kind of pulling off the table the prospect for rate cuts for kind of the balance of the year. It's interesting, if you go back to November, the market expectation was probably 4 or 5 cuts. By December, that was down to 2 to 3. And where we sit today, there's a 50-50 chance that there's 1 and 0. So the Fed has shifted a bit more hawkish in their tone, so the expectation is higher for longer, and that's where you've seen the equity markets trade off here in April, just having to manage through or process the outlook of continued high interest rates. I don't have this perspective from an age standpoint, because I can't tell you that I remember my parents buying a house in the early 80s and paying 16 or 17% for a mortgage. I remember playing in that house, but I don't remember anything about the transaction. But it is funny to me, even in my 24-year career, to hear, well, 4.7 is really high for a 10-year treasury. That's still below the long-term average. So these are higher rates in terms of our perspective, and I think our desire to have super low interest rates from a consumer standpoint. But from an investment standpoint, this is certainly creating all kinds of opportunities, some of which we'll talk about in the later part of the agenda. But I'll take you right in and just talk about overall results. First, stop at page 3. I always like this test from a visual standpoint. Right, this measures kind of the history of the township deciding to bond to cover the liability and invest those assets into the equity markets. If we go back to April of 14, so this is actually now a 10-year anniversary. So an $84.2 million beginning market value. We've had transfers out of the equity portion of the portfolio of about $39.5 million. That's obviously gone to the guaranteed account to help pay benefits. But over that now 10-year time period, we've had gains of $59.5 million to where we sit today at 104.2 for about an 8.5, almost 8.6% return. So if anyone asks, was the decision to issue the bonding and invest into the equity markets wise? I would say absolutely. Even if we were paying 4.5% on that debt, we've covered that plus another 4% on top of it. So as we talk about overall results on pages 4 and 5, something to keep in mind is when we talk about the equity markets, the interesting theme was 3 names either helped you or hurt you. And those 3 names were Apple, NVIDIA, and Novo Nordisk. Either being, all being the largest stocks or almost the largest stocks in their respective benchmarks, and all being significant drivers of return either to the positive side or to the negative side. So the overall DB portfolio was up 6.26% for the quarter. It was behind the policy index that was up 6.67, and for the fiscal year, just shy of a 16% return. So strong from a positive standpoint, but lagged the overall index that was up 18.5%. From a manager by manager standpoint, Ancora underperformed for the quarter by about 2% because they owned Apple, and Apple is not in their benchmark. Edgewood outperformed for the quarter because they owned more NVIDIA than the benchmark. All else being equal, one stock in each of those portfolios drove returns. Clarkston underperformed for the quarter by about 2.5% because of one stock, Clarivate. It's one of their largest holdings in the portfolio. It's a spin out from Thomson Reuters. It's a data analytics company based in the US and UK. Reinhardt, new addition to the portfolio, outperformed for the quarter. So recall we had added that as kind of a diversification away from just having Clarkston as the sole active manager in the small cap space. And Reinhardt's been off to a great start. That was also just recently added to the retiree healthcare portfolio post-consolidation. And saw an immediate benefit there from a cost standpoint. So we were able to add Reinhardt and retiree healthcare in a separately managed account instead of a mutual fund. And accessing it via that vehicle is about a $5,000 a year cost savings for the retiree healthcare trust. So nice to see an immediate benefit to the consolidation of those assets from an investment standpoint right out of the gate. From an international equity standpoint, Oakmark, significant underperformance for the quarter because they didn't own NVIDIA. 4 of that 5% underperformance was because they didn't own one stock in that portfolio. We're going to do a deeper dive, just given the continued underperformance here, just to look at historical periods of underperformance. We'll do the same thing for Clarkston as well. We do have the benefit of the long-term numbers for Clarkston are actually ahead of the benchmark, but just to kind of help better understand how that historical trend has worked. JP Morgan, from an emerging market standpoint, slight outperformance for the quarter. So the one negative, and get a bit more color here, but TerraCap was down 30% last year. Here, let me grab. So this all came when fourth quarter financials came out. They appraised every one of their properties in their portfolio. And because those appraisals are based on recent transactions, most of the transactions that happened in 2023 were not trophy buildings being sold to an insurance company at, an attractive price. It was, I'm upside down, my mortgage is, my commercial mortgage is due, it's expired. I don't want to put more money into this building, and I'm going to sell it for 30% less than what it was worth a year ago. So properties are still cash flow positive, still generating rental growth, still generating leasing growth, but because the current marks of other transactions in the fourth quarter were all down significantly, they had to reappraise all of they had to take those marks. Now, to put it in a bit of perspective, right, so we've talked in the past about leading indicators and lagging indicators. Like the equity markets are a leading indicator of economic activity. Unemployment is a lagging indicator of economic activity, right? Market goes down before we go into recession, but unemployment stays low. We're in a recession, unemployment starts to pick up until we come out of it. So equity markets being a leading indicator, if we look at publicly traded REITs in the US, so publicly traded real estate stocks in the US, broadly speaking, peak to trough, so top to bottom, which would be beginning of 22 through October of last year, broad US publicly traded real estate stocks were down 31% from Jan 1 of 22 to October of 23. Industrial REITs. So industrial properties have kind of been the belle of the ball because we can't buy enough things online. Those were down 37% for the same time period. Residential, down 37% for the same time period. Office, same time period, down 57% from top to bottom. So publicly traded real estate and private real estate are similar. Publicly traded has a tendency to have bigger swings, just from a market volatility standpoint. So as we look at what's happened in the public market, it mirrors what's happened within TerraCap's portfolio. I have the utmost confidence that we're going to see a recovery there. It's 2 years in to a 5, 6, 7 year fund. So with seeing what's happened from a public market standpoint now rolling over and impacting things from a private market standpoint, it's never good to look and say, oh, down 30%. But when we look at it in context of what's happened in other parts of the market, we understand where those appraisals came in, and would expect, in the coming years, you're going to continue to see a recovery there.
Brian, just a question. The markets that we're in with TerraCap, I thought were really supposed to be distanced a little bit from the hardest hit of the urban markets that we have. And so you would expect that this would now, especially with kind of cleaning the house up, that we would see some improvements going forward, I would suppose.
That is the expectation. I mean, they had the double whammy of, we got to use the 10-year Treasury at 4.2%, not at 3% in terms of determining the cap rate on the portfolio. So okay, that's a 15% decline in value. All else being equal, just rates moved up 1%. That's immediate impact to the pricing of the portfolio. And then when you throw in, hey, what are other properties in this area selling for? Well, there's still distressed sellers in really, really good markets. The difference is a year and a half ago, TerraCap was the one that was the acquirer of those distressed assets, but now that they're out of their investment period and are, working through executing the strategy on the apartments and offices and industrial properties, it's others coming into that market going, yeah, I know you bought that apartment complex last year. This one just came online, and the developer can't refinance the construction loan on it, and that one's going to be sold at 30% below what it was appraised at a year ago. So it's a function of what's happening in the real estate markets right now.
So as you pointed out, that one of the reasons for the decline in book value is the interest rate being high. So even if it takes a year from now for interest rates to come down, we're going to see that reverse.
Correct.
We'll see a pickup to value as those rates decline.
Exactly.
Right.
Yeah, and they appraise everything once a year. So, no change in interest rates from this year to the next, but transaction activity picks up, you'd see some recovery. And if we see a decline in long-term interest rates, that's obviously going to be a big impact.
But you're saying that the rates are only half of the story on this one? If you said that equates to 15% of it, there's still 30% up to 50 in some areas.
So half the decline, so 15 to 30 is due to interest rates. The other half is due to the appraisals in market are based on recent transactions activity, and all of that transaction activity is distressed sellers. And the example that I'll give is, let's say my house right now appraised for, I used to use the example of $250,000, but I don't even know where you can buy a house for $250,000 anymore. I think my house is worth $500,000, and my neighbor sells his for $450,000 because he has to sell it, right? He's upside down in his mortgage, whatever, his financial situation has changed. Well, from an appraiser coming through, we're looking at recent comps, like you guys have the same house. I don't care if you think it's worth $500,000, that just sold for $450,000, that's the comp, that's the appraised price. I'm not selling it, I have no interest in selling for that price, like I don't need to move. I have the luxury of time now that, either interest rates adjust or, the beauty of inflation, like I don't have to sell it at that price, but I have to, as someone who has to carry it at, current market value for audited financial purposes, I'm not going to sell it at that price, but I have to carry it at that price because that's current fair market value. But they have 3 to 4 more years from a business plan standpoint to lease up properties and improve properties, and assuming rates come down a little bit, that will all be things that ultimately benefit the portfolio.
Even if you see a consistent decline over those 3 to 5 years, you would still stay at the same level we're at. Like, not completely pull out, but stay at the same level.
Yeah. Yep. That's everything I have there.
Oh, was that everything? Okay. Everyone got their questions answered on that? Why don't you touch on page 6, our allocations? As everybody knows, we made changes to the investment policy back in February that updated the allocations, and so these reflect the new allocations.
These do not yet.
Oh, these do not yet. Okay, I'm sorry. So these are the older allocations.
But I think, say, one piece that's worth noting here is, we've talked about real estate being a difficult sector. We have a 10% target with 5% exposure currently. So we're underweight real estate.
Yep.
One of the opportunities we're going to be talking about later on the agenda is bringing real estate back to its target, but doing it via a debt, a lending vehicle rather than equity. This will be updated going forward as we implement the new investment opportunities, adding to private equity, private credit. Once we have money there, then that's when this page gets updated, because now it's like, oh, we have those investments, now we'll reflect whether they're in compliance with targets.
Okay, one other item on the pension plan is the 400-pound gorilla in our portfolio, which is the guaranteed deposit account from Empower. I have an accounting of the MFL, the MIFL, the minimum funding liability, as of March 31st. We have $126.2 million in our fund. That's our cash fund that they hold, the GDA. And our minimum fund liability is $119.4 million, meaning that we have a $7 million surplus in our MIFL for the Empower account. Whenever that number goes into a deficit, they always call up and say, okay, you got to give us money to make it so that you're not in the deficit, but yet we can't call them and ask for money when we've got a $7 million surplus. So for the time being, we're not going to have to deal with any kind of MIFL payment into the Empower account at this time. So, and the good news is that the benefit of the high interest rates is that it's keeping that liability low, and so we are well funded on that. Okay. The next item is the defined contribution plans. Didn't want to spend a whole lot of time on that. And so I didn't ask Rob to come in, but we'll definitely get him here for the next meeting. But basically, we had a 8% increase in our assets for the participant-directed investment account. So that's the 401A defined contribution retirement plan for our employees. The deferred compensation 457 plan, which is the employees' discretionary savings that they want to take out of their earnings, and the retirement health savings plan. So the total amount there is a little over $60 million, and as I said, that's up 8% versus December 31st. So that includes both increases in the underlying holdings in those accounts, but also it also takes into account all the contributions from the employees out of their checks, and of course what we put in for the DC plan, the 401A plan. So, any questions there? Okay, great. Okay, so moving on to, and Brian previewed it a little bit, is the new investments discussion. So we have, even though our plan has been around for 60 years, we have a very unique situation with the guaranteed deposit account with Empower, in that that account, which is more than 50% of our total portfolio, is where we fund all of the benefits that our plan pays to the retirees. So the discretionary account, as I called it, or the equities portfolio, which Brian said is now over 100 million, is really, it doesn't get tapped for quarterly or, monthly payments to our retirees. And so I thought, and I brought Brian into this conversation about, and wanted his advice on opening up the fund to new investments, and investments that are less liquid, sort of like the real estate portfolio that we have already, and adding to that real estate portfolio, and also bringing in some alternative investments. And again, since we don't have to pay monthly cash flow out to our retirees from this fund, we have the ability to take some time to invest in less liquid but potentially higher yielding investments. And so I asked Brian to put together some investment options, and their firm does a lot of work, and I'm sure he'll talk about that in terms of vetting different investment options. And so I'd like to bring those to the board for a discussion.
Great, thank you, Michael. So, start with a couple things. So everything we're talking about here would be new to the township, but these are not investments that are new to us as Mariner. These are not investments that are new to public funds across the country, and these are not investments that are new to other public fund peers around the state. So every fund that we're talking about, every recommendation that we provided to Michael in terms of candidates and ultimately who we think should be added to the portfolio, are firms that we've fully vetted from a research standpoint. And to give you an idea of the scope of that, you know, there's a firm called Marathon that we're going to talk about that is a distressed debt investment. We've met with 100 plus managers over the past couple of years that all operate in that space, and all of those in-depth meetings allow us to say, no, this is the one, or these two are the best opportunities. So we think it's important to provide that context for clients of, like, we may present you with a list of candidates that's only 3 or 4, but it's because we've talked to many more than that to be able to understand and determine that these are the best 3 or 4 candidates. And kind of think about it like, for you, from a hiring standpoint, like from an HR standpoint, right? You're filing, you have an open position and you're trying to hire one person. Like, it's not one resume and one person that you interview. It's 100 resumes and 10 people you may interview to decide that this one candidate is the best option. So there is kind of that funnel and that vetting process. The other piece that I think is important to note is the opportunities that we presented for consideration and have worked through with Michael are all strategies that we either have previously invested with Mariner clients and with clients of mine around the state of Michigan, and or are current investors in those funds. So neighboring communities and their pension systems and their retiree healthcare trusts are all investors in a number of these different portfolios. So this is new to the township, but this is not new to us or new to your peers around the state. So what it really comes down to is, the idea behind adding real estate to the portfolio was trying to have an increasing part of the portfolio decoupled or not dependent upon the S&P 500 going up or down, right? We need less reliance on Apple and NVIDIA to do their thing, and more reliance on more opportunities and more professionals. So what's interesting is, what we start here on page 1 is just kind of addressing the challenge, trying to generate attractive returns. And you see, for example, if we look at forecasted returns, things look pretty rosy. 7.9% return expected in the next 10 years out of U.S. large cap stocks, 4.6% out of fixed income. A couple years ago, that number wasn't even a 2. That gives you an idea of the impact of a rise in interest rates. It's been hurtful to real estate, but for fixed income investors, it's a good thing. You'll see, for example, private equity expected to generate a 9.9% return, and senior direct lending, which is a form of private credit or private debt, a 7.8% return. So the idea is adding other asset classes and other investment opportunities in the portfolio that are expected to generate a similar return to what we would get out of stocks, but maybe with a little bit less volatility, or a higher return than we expect out of the stock market with an equivalent amount of volatility. So it's just diversifying our sources of the ability to generate returns. So let's start on the private credit side. What is it? Private debt in institutional portfolios, I will say, it's the current kind of, fad is the wrong way. There are more assets, investable assets flowing into private credit right now than in the history of the capital markets. And that's for a couple of reasons. As we talk about this private debt space, what we're talking about is lending to businesses, lending to opportunities, right? So that lending market has existed since the earth began, right? Institutionally, it's existed since the 80s, but you could go back to the 1600s and someone was providing a loan to someone else, right? So that mechanism has always existed. I will tell you the big change has really happened in the last kind of 20, 24 years has been the shift from banks being the provider of that capital to Wall Street being the provider of that capital. If we go back to 2000, better than 90% of small business lending was done by banks, less than 10% was done by Wall Street. That number is now the exact opposite. Traditional banks are doing less than 10% of lending from a small business or corporate standpoint, and better than 90% of it is being done from Wall Street. Why is that? A couple different things. Number one, big changes from a regulatory standpoint. Coming out of the GFC, a lot of change from a bank lending standpoint. A lot of these firms, a lot of these teams came out of banks, right? They were at JP Morgan, Bank of America, Wells Fargo, regional banks. And as regulations changed and their standards had to tighten, I'd say probably for good reason, those teams were essentially said, listen, we aren't doing that type of lending anymore. That need still exists, so they took their team out of the bank, opened their own shop, lending to the same customers, now on better terms from an economic standpoint, and rather than operating under a bank regulatory framework, they're operating under an investment management framework. So they're doing the exact same thing they were doing before and making more money doing it. That trend is never going to switch back, right? We're not going to go back inside of a bank and make less money to do the same thing. The other is, and you'll see things like this, KeyBank was noted, a lot of what you're seeing now is what's called lane financing. And it's one of those, it doesn't matter that you've been a customer of the bank for the last 30 or 40 years. If it doesn't fit in this exact framework, we're not doing it. So you're seeing, this is where Wall Street is kind of filling the gap from an investment standpoint and creating that space. So it's a very, very large market. It's a market that continues to grow, but it is a market that pales in comparison to private equity, as an example. So take a look at page 3. Really what we're looking at here is two things. It's senior direct lending. So this is senior secured loans to corporate borrowers and distressed debt. So the strategies that we presented to Michael are kind of fit into two different veins. Senior direct lending, this is the liquidity or the lending that exists in the private equity world. So for a private equity fund to purchase a company, right, that's equity. They need debt to help finance that. That's where direct lending comes in. So these are the funds that are providing liquidity or the leverage into the private equity marketplace to acquire companies. Or they're working with existing borrowers, existing companies to help finance the growth of their business. Most of these loans are SOFR, which is the new LIBOR, plus 6%, so kind of 13 to 14% interest, plus a point or two, plus, guaranteed interest for 3 years, like a number of different options. So what it ends up creating, and this is why we think the asset class is so attractive, is on the conservative end, high single-digit return, and on the aggressive end, kind of a low to mid-teens return. But if you think about it, like how is the return being generated? It's interest, right? If I make my mortgage payment every month or I make my car payment every month, a portion of that is principal and a portion of that is interest. So this isn't investing in an asset class because I want the value of the thing to go from 1 to 2 or from 100 to 120. It's I want to loan you the money and I want you to pay me back plus interest. So it's literally a return stream that's paid quarterly. So for a mature pension system that has cash flow needs on occasion, it's a really, really attractive return stream from the standpoint of it's expected to do at or better than the equity markets. And I don't need to wait for the value of something to increase and then sell it. I just need the borrower to pay me back. Distressed debt, a little different. This is a little bit more opportunistic. These are the companies that are going in and helping in a bankruptcy situation, providing rescue financing. A prime example of this, and Marathon is the firm we'll talk about. This is the second fund, but anybody remember March of 2020? I think we've all kind of tried to block that out of our memories. They were providing lending to Hertz in late 2020, right? As Hertz was going through the bankruptcy process. I don't know if anybody's tried to run a car lately. It's expensive. It's like legitimate. Like I was in Boston yesterday, and I looked at my Hertz bill and I was like, this is like a car payment. This is part of a car payment for me to buy. Like I needed this to drive 20 miles, and this is almost feels like a car payment in terms of what I'm paying for the convenience of having access to an automobile. Lending to airlines, lending to the equivalent of Travelocity. So those are examples of where they're able to provide capital into a situation that is in some form of distress. How is it built? So take a look at page 4. This is where it's interesting. So we're talking about the compensation for locking up your money, right? So these are illiquid vehicles. So on page 4, we lay out kind of where the return premium comes. So you'll see the green bar in the bottom left-hand corner would be broadly syndicated loans. So this would be publicly traded debt. These would be things that would be inside the Baird or Brandywine portfolio, below investment grade. So, based on the end of 22, a yield of 8.3%. Because we are working with firms that directly originate, so we're the only lender, they're the only borrower. It isn't 5 lenders getting together. That adds 2.1% to the return. From a market standpoint, they're focusing on the lower middle market. Those would be companies that have EBITDA in kind of the $10 to $50 million range. So these are companies that are worth somewhere between, 80 million and 500 million. Ironically, those are kind of treated as small businesses when you think about Apple or Microsoft being worth $3 trillion. But these are not companies worth, $5 million. These are well-established, good-sized companies. That adds another 1.3% to the return. Then we go to non-sponsor-based borrowers. So that is lending directly to a company, not lending via a private equity acquisition, right? So this is ongoing relationships that I have with an automotive supply company that continues to grow, or a chemical manufacturer that continues to grow. So that adds another 1.5% to the potential return. And then as we get into some of the more aggressive stuff, the term is subordination, or that's saying, I'm not going to be in a senior position. The example I could use from a personal mortgage standpoint is this is going from first mortgage to home equity line of credit or home equity loan, right? I'm now in the second position where if something happens, I could be impacted. Well, I need to be paid more for that risk. What we're focused on and what we're looking at for the DB portfolio is not in that subordination position. It's only senior secured opportunities. So what do we look at? One of the biggest things I talked about, this is a landscape that's changed, or investment landscape that's changed because of regulatory changes. So there are thousands of investment companies out there that want to raise capital to invest in private lending, thousands of them. There are less than 50 that existed prior to 2008. We've met with all 50 of those. Because from our standpoint, we don't want to invest in a company or a fund that started in 2016 or 2018 that hasn't had to lend through a recession. We want to see a proven track record of you made a loan in 2007 and then we had a major recession in 08 and 09, and how did you work through that? So that's where the opportunities that we presented and have worked through with Michael are all companies that have a track record that predates the GFC. So they were doing this in 2006 and 2007 and had to manage their loan portfolio through a major economic crisis. One of the pieces that we look at is, their loss rate. When you think about it, you make a loan to someone, what's the upside? There isn't any, right? It's make the loan, get paid back. What's the downside? Well, the downside, in theory, your upside is capped. It's whatever your interest rate is. Your downside, in theory, is unlimited because they could pay you nothing back, right? So kind of the industry average from a loss rate standpoint is between 0.5 and 0.8%. Where think about it, I loan out $100, I get paid back somewhere between $99.50 and $99.20. The strategies that we've brought forth from consideration standpoint have a loan loss rate of less than 0.1%. And we say it's less than 0.1% because we only went to one, we rounded it. Most of these are like 0.05 or 0.06, or put another way, for every $100 they've lent over the history of their firm, they've captured $99.94, $99.95. Like they just don't lose money on loans. Which we think is attractive because the whole purpose of making a loan is to turn around and get it paid back. So it's, that deep track record, depth of experience, strong underwriting, right? Those very, very low loss rates, not only versus the industry, but versus peers as well. So then we've provided, on pages 6 and 7, an overview. So as we kind of talk through the process that Michael and I have gone through is, we worked with our research team and we scheduled meetings with a number of different firms, Bloomfield Capital, Marathon Capital, Monroe Capital. Based on that, we scheduled another meeting with a firm called Deer Path Capital. And then Michael actually joined. We were doing an educational symposium with Southfield's Fire and Police Pension System, where they had presentations from an educational standpoint from Bloomfield, Trust, and Marathon. So brought him in as a part of that, just to better understand and do a deeper and deeper dive into each of these organizations. So Bloomfield Capital is actually based in Birmingham. I always love these naming conventions. Clarkson Capital is actually based in Rochester. They were in Bloomfield Hills, but they moved to downtown Rochester. Bloomfield Capital is based in Birmingham. It's a firm that we've invested client dollars with for the last 12 years, 13 years. And they provide bridge loans to real estate opportunities. So I talked about earlier in the meeting being underweight real estate. We're at about 5.5% versus the 10% target. Is we've made the recommendation to Michael to have an allocation of Bloomfield Capital as a private lender in real estate, but it's within the real estate allocation. So if we think about kind of rounding out the real estate bucket, rather than adding more equity exposure in the current market, is adding lending exposure to real estate. From a private debt standpoint, it's Marathon and Deerpath. So Marathon is a New York and London-based, very, very well-established company raising a distressed debt fund. So they're investing in distressed companies. Now, there are companies that are out every year, every other year, fundraising for distressed debt. This is the second one that Marathon's done. The last one was, 2019. They started raising capital with the expectation of, we think something's going to happen from an economic standpoint. They didn't know that thing was going to be COVID that would cause an immediate recession. So much more patient, much more thoughtful in terms of, we're only going to be out in the market raising a fund when we think there's some distress to turn around and invest in. And then the next piece we started to walk through and work through, if you take a look at page 11, was private equity. So from a private equity investment standpoint, it's like walking into Kroger or Whole Foods. There's so many options available to you. The recommendation that we made here was actually investing in what's called the secondaries fund. So rather than our dollars being new dollars going to work, it's our dollars are purchasing interest in existing funds at a discount. So in this case, the recommendation was a firm called Capital Dynamics, which has a long track record in this space. And the way a secondaries fund works is, the general partner on our behalf and all of their investors is going out and purchasing interest in existing private equity funds. So the beauty there is we're purchasing funds that started investing in 2015, 2017, 2020. So you can go back in time from an allocation standpoint, and you create a bit of a cushion because the fund interest that you're purchasing, so I used the TerraCap example earlier, right? Like they had to appraise everything in their portfolio to create kind of fair market value. Same thing happens from a private equity standpoint. They have to value those companies. They have audited financials for their funds on an annual basis. Well, in a secondary transaction, we're purchasing interest in that fund at a discount to the current value. We may buy it at at 80 cents on the dollar. So if it was worth $100 million in market value, we get to purchase it at $80 million because it's an illiquid transaction. That creates either one of two scenarios. The opportunity for a nice bump right out of the gate from a return standpoint, or if we bought it in a period of distress and things got worse, there's a cushion there, right? Because we've bought it at a discount. Even if that value comes down a little bit more, it creates a bit of a discount. It also creates the opportunity, when building out a new allocation, is we expect probably 35 to 40% of the commitment to go to work right away. So rather than slowly building a private equity allocation over time, it's the opportunity to have kind of an immediate impact to the pension system and the return opportunities right out of the gate. It's a lot in a short period of time. I'm going to pause there. Defer to Michael in terms of anything that he wanted to cover that I missed, and make sure you have an opportunity to answer some questions.
Sure. I don't have anything at this point. I just wanted to open it up to the committee to see if there are questions. I'm sure there probably are. You went through a lot, and I just want to level set here. So this presentation is actually an amalgam of multiple presentations that we worked through, or that I worked through with Brian. And so Deerpath is not in this. We didn't grab a slide about Deerpath, so I apologize for that. I guess the first thing we'll do is open it up for any questions and see where that goes, and then I can share my thoughts after.
I was the one that asked about Deerpath because you have entrust in here.
Yeah.
So can you just give like a quick highlight that we would have gotten in here that would compare?
I can add that. So Deerpath is going to be very similar. Like the information and the comments you see on Monroe Capital in there, Deerpath would be a Monroe competitor. So, the entire approach for them is, I'll use industry jargon. They provide lending in the lower middle market. So it's kind of that we're lending to companies worth, $80 million to $500 million in first lien position to give them the leverage or the capital they need to grow their business via acquiring a competitor or building out a new business line, things like that. Similar terms to Monroe, the expectation is probably a 12 to 13% return in the current interest rate environment. If rates decline, that number's probably a 9 to 10% return. And if rates go higher, as much of that scenario as I don't think anyone wants right now, that kind of 12 to 13% becomes more like a 14 to 15% expected return. So pretty attractive from a long-term return standpoint. Very conservative in what they do. So their approach is they have teams based all around the country that work with their borrowers in each of those regions. So it's not one team in New York or one team in Chicago. They're scattered around the country so that they're in their regional markets to drive loan opportunities. I think one of the most important pieces for them is their loan loss rate from a historical standpoint is one that's less than 0.05%. So in terms of their track record dating back prior to 2008, in terms of making a loan and getting it all paid back is arguably one of the best in the industry.
Brian, I think it's actually a very nice opportunity to get some additional return from the portfolio. I just think we need to, remember, this does increase volatility, at least in this sector, when there's macroeconomic factors that go. And so we fully expect that we would be compensated for that with the higher return, which should happen. But I think going in, we ought to be very clear that in a recession or a macroeconomic environment that is not so friendly, we are going to see some swings that we can't easily get out of, that will be compensated hopefully over the longer term, but we will see some volatility more than we have right now in the short term. Hopefully, and I think that reasonably expecting to balance that with higher returns.
Correct. Yeah, that's right. The compensation for the increase in risk, and that risk is in terms of volatility, right? The movement of the value of it, and the illiquidity in that you can raise your hand and say you want out, but there isn't a mechanism that exists to get you out. Can you sell it? Yes. That would be a secondary transaction, right? But
and you take a hit selling it under those
Exactly.
Yeah.
But the compensation that you expect to earn for taking on that illiquidity and taking on that risk is a higher return than you would get owning an S&P 500 index fund. And the whole idea here is diversifying away from just relying upon, the Magnificent Seven to continue to be the Magnificent Seven.
Other questions, thoughts? No? Okay.
Hard to summarize
Yeah.
in 20 minutes what we've spent
Yeah.
30 hours on
Yeah,
over the
weeks.
course of the past couple of
Weeks.
months.
So I'll share some. So my thoughts are, when I sat down with Brian to discuss these options, is as I said before, we're not at the stage of the life cycle of our pension plan where we are relying on cash flow on a monthly basis to pay our pensioners. We have the guaranteed deposit account for that. And so we have now a $100 million discretionary fund that we can invest, and the goal is to get the maximum return out of that money that we put aside for ultimately funding the plan. But, the retirement plans are going to be around for 40, 50 years at this point. So from a discretionary investment standpoint, I think we need to look at things from a longer term lens. The other thing that I was looking for is I wanted, obviously, preservation of capital is key. And so most of these opportunities that we've looked at are in the private credit space, but they're senior positions. Whether they're corporate, whether they're real estate based, it's senior position lending. So we're not subordinated to anybody, which means we get paid back first. Unlike TerraCap and Principal, which we have in our real estate allocation, that are equity funds, and the equity gets paid last, I like the opportunity of looking at these funds where we get paid back first. And that includes with the interest that we have to get paid back before anybody below us, whether there was a mezzanine or a junior lien or anything like that, or even the equity in the company that we're investing in, we get paid back first, and we get paid back first with our interest. The other thing I would add is I had a chance to speak with all of these companies that we looked at, and most of them more than once. In the case of Bloomfield Capital, I went to their office and didn't just talk to, the head guy and the investor relations guy that's there to sell me. I went and talked to their individual credit analysts, asked them how they look at things, how they think about things. So I really spent a lot of time doing due diligence on these opportunities. I also spoke with other like investors in these opportunities. So I talked to City of Southfield, his treasurer of Lowenberg, who's the guru of city treasurers in Michigan. He's invested in a lot of these. He's invested in Bloomfield. He's invested in Marathon. I talked to West Bloomfield. They're invested in a couple of these companies. I talked to Oakland County and Macomb County. They're also invested in a lot of these opportunities. So this is not a stretch by any means in terms of making these investments. We're really doing what a lot of other investment bodies do around our state, at least. And so my recommendation and what I'd be looking for, the board to provide their opinion on is to make a allocation to Bloomfield Capital as part of to fill out our real estate allocation of 10%. And just confirm that, 10% is our target. We have 15% maximum, but 10% is our target. Right now, we're about 5%. So putting in about 5% of the allocation to fill out the real estate up to 10%. And then we also have a 5% allocation to alternatives. And remember, this is 5% of the discretionary funds. So when you think about it from an overall portfolio standpoint, 5% of our discretionary funds is more like 2% of our overall portfolio when you factor in the GDA as well. So not a huge allocation. I think it's worth it, like Dave said, there's going to be, some volatility included, but the plan is to hold these and realize the life cycle. And so in the alternatives, my recommendation is to make allocations to Deer Path and Marathon, and then also Capital Dynamics, which is the secondary private equity fund that Brian was talking about, where instead of making an investment into a private equity fund, we're making an investment into a group that buys other people's investments. So other entities that need to get out of their private equity allocation, there's a secondary market to be able to get out of it, and we would be buying, our investment would be going to fund those purchases. So the benefit of that is that you see what the underlying funds have invested in, and you can underwrite to that to that portfolio, so hey, they've invested in venture capital, they've invested in buyouts and whatever else they've invested in. They can pick and choose from that, and we don't have what they call blind pool risk, meaning when you join up with a private equity fund, they say, yeah, we're going to invest in buyouts, okay, but you don't know which ones, and so it's really relying solely on the track record when you make those types of investments. But with the secondary, and this is the thing that I liked about Brian's recommendation, is that again the investment that we're buying into is going to say, look at the underlying portfolio that you're buying into, and to see what value can be derived from buying in the secondary market. You're going to buy it at a discount, so you're going to get an immediate write-up and greater long-term returns from that. So for all those reasons, I think that this is a great opportunity to diversify our discretionary portfolio, and realize more returns to keep our pension plan funded for a long, long time. So that's my pitch. Happy to take questions or thoughts.
I just have one for, I think, Brian and Michael. Volatility was brought up, and then the long-term nature of the vehicles. I'm always sensitive to how do these get marked to market at fiscal year. We saw it with TerraCap this last fiscal year. We had to book a again, I understand your whole explanation over not selling it, we're not getting out of it, so we'll eventually recoup it, but on an audited financial statement, we show that as a loss to the revenue, a decrease or an offset to other revenue items. So I'm just a little concerned on adding another volatile piece of these at March 31 of each year. Is there going to be a year where we have, between TerraCap principal and these other vehicles, potentially $1 million or $1.5 million or $2 million in mark-to-market loss, that then, when you look at our financial for that year, actually throws it into a negative balance? And again, I understand that's not a locked in, but we do have to report it.
So a couple things. First, all of these funds are going to issue quarterly statements, and they're going to do audited financial statements December 31st of every year. So with a March 31st fiscal year end, it kind of ties out and works well from an audit standpoint, in that about the time we're starting to go through the audit, we're getting audited financial statements, that are only a couple months old. That differs a little bit, for example, for communities that have a 12/31 fiscal year end. They're a little delayed because the statements take time to put forth. I will tell you from a historical standpoint, I have not seen the degree of volatility out of private equity commitments or private credit commitments that we've seen out of real estate. Real estate being 08, 09, real estate being 09 and 10 in terms of big drawdowns for private real estate, and 2023 for private real estate. If anything, because these are private assets, there's a bit of a lagging indicator. So you're going to have to process, let's say 2024 is a bad year for the equity markets and we're down 20%. You're going to have to book a $16 million loss because of the public portfolio. And you're probably going to see no change on the private because it lags. And then the following year, what typically happens, the equity markets recover, you're going to have a gain to book on the equity side of the portfolio and a loss to book on the private side of the portfolio. So they kind of balance each other out because of the leading nature of public markets and the lagging nature of private markets in terms of the impact to pricing. If I go back to 2022, difficult year for the equity markets, difficult year for fixed income, we still saw positive returns out of the private equity and private credit allocations that we have because of the private nature of it. And even in 23, equity markets are roaring. For the private equity and private credit allocations, we still saw positive returns. So there hasn't been that same amount of volatility compared to what we've seen in the public markets.
Yeah, one thing I would add to that is, in thinking about that, one of the reasons why I wanted to include the allocation to Marathon is Marathon is like the counter-cyclical play. They invest where there's, market dislocation, distressed opportunities. They buy debt cheap and do workouts. So they're kind of the, a balancing feature, right, between the Deer Path, let's say, or Bloomfield versus Marathon, which is like kind of counter-cyclical. And the thing I liked about Marathon is that the way they structure their investment is they say, okay, if your commitment is $2 million, we're only going to call $1 million of it and put that to work unless certain criteria in the market are met where we think that the opportunities are such that they're too good to pass up. So then the other 50% of your equity can be called, or 50% of your investment can be called. And so they set forth, I think it's on page
9.
9, thank you, of this presentation. You can see at the bottom there, it says, okay, these are the triggers that say we can pull 50% of your commitment, either an increase in high yield spreads, a decrease in high yield prices, or an increase in default rates among lower middle market corporate debt. And when we first started talking to them, there had been no triggers, so that was something to think about. But since that time, they said, okay, well, we've now reached a trigger point. Their 12-month default rate is greater than 4%. So we now think this is a great time to get in. So we're calling the other 50% of commitments. And so I kind of looked at it as like, doubling down is like you make your initial investment, and if the cards are in your favor, you get to put another, double down on that day. And so that's one of the things I've liked about the Marathon investment. But since we've been talking to them, they have since, pulled the trigger on this because of the default rates. So obviously, they see a lot of opportunity in the market, and I think that they are kind of a yin to the yang of some of the other opportunities.
We asked the question of, like, as we were having conversations with Marathon, with Monroe, with Deer Path, with each of these, we said, what do you know of this other firm? So, like, when we were meeting with the Marathon team, we said, what do you know about Deer Path and Monroe? And the comment was, I know them, I like them well, but I never get to do, but I don't like them because I never get to do business with them. Meaning, like, if Marathon is the company that's purchasing the distressed loans, they've never purchased one from Deer Path. They're like, we have a tremendous amount of respect for them as lenders, but we never get to do business with them because they haven't made a loan to a company that's gone into distress, where we can now use that as an investment opportunity. And it was an interesting kind of backdoor compliment to, we play in the same space, but we never get to work with each other because they haven't messed up, or haven't had a company not execute the way that they intended to.
That they couldn't fix.
Yeah. Yep.
Other thoughts? I was able to speak to Neil about it. Neil is off today on a personal item, and so, but I was able to fill him in on what we would be talking about. So, and I don't know where Dave is. Other thoughts, questions? Anybody?
No, thanks for doing the due diligence on that. I know that was a lot of work,
Yeah.
but you really did your homework, it sounds like, so we appreciate that.
Yeah. That's my job. Okay.
Sometimes it's more exciting than T-bills.
It is. Okay. Well, as an advisory committee, we don't typically vote on things, but is there anybody that has any concerns about this, or? I mean, Jason has his return, and I think Brian addressed it, because, the public markets may go down, and we have to write that down every year also, so. But obviously, the marks to market are of concern. But it wouldn't hit our general fund books.
Correct.
This would only hit the pension fund books. So it doesn't affect our annual budget, and whether or not we would have to take a loss in the annual budget does not impact that.
And like you said, it's a small enough percentage of the overall portfolio that gives me the comfort level of, using this.
Yeah. Yeah, and I joked with Empower. I said, okay, so there's an $8 billion surplus. When can I expect a wire? And they're like, well, it doesn't work that way. I said, well, so the next time we have a deficit, it's not going to work that way. But, we'll see how far that gets us. But all right. Anybody else? Anything? All right. And that concludes new investments. The next meeting of the committee is Thursday, August 1st, 2024 at 8 a.m. in this room. And if there's nothing else, then I say we adjourn. Anyone want to call a motion to adjourn?
Motion to adjourn?
Okay, and a second. All in favor? Aye. Okay. We are adjourned. Thank you very much.